Hey everybody, thanks for joining us today. As we wait for some other people to get in here, we'll do a couple introductions. My name is Shane. I run the events over at 10 Capital. We have a great session for you today, all about retail, selling your business. We have Richard Kestenbaum from Triangle Capital, and our CEO, Hall Martin. So with that, I'm going to let Hall take it.
Great. Thanks, Shane. And thank you guys in the audience for joining us today. We have a great speaker here with Richard talking about how to maximize the value of your company upon exit. We're going to focus on retail companies today. If you have questions, go ahead and post them in the chat box. We're going to kick off in a moment with a few questions for Richard, but happy to answer your questions as we go forward. And if there's anything else we can help you with, please let us know. With that, let's go ahead and bring Richard up. Richard, thank you for joining us today. Can you kick off and tell us a little bit about yourself and your firm?
Sure, and thanks so much for having me. It's a pleasure to be here. I've been an investment banker for over 40 years, doing mergers and acquisitions and focused on consumer and retail. My firm's called Triangle Capital, and our website is trianglecapitallllc.com. I was previously a partner in a big firm on Wall Street called Drexel Burnham, and I've also written 3 books on finance and computer science. I taught international business at New York University, and I'm a regular contributor is my title. I write articles on Forbes.com about consumers and retail. And yeah, keeps me busy.
Great. Well, thanks for that. Well, the topic today is about selling your business. And before we dive into retail, let's talk a little bit about selling the business. We have many people in our group that are looking to monetize their business and sell for various reasons. But when one starts to think about selling their business, when should they start to prepare for selling it? What should they do in advance of that moment of actually going out to actually promote the sale?
Well, the big things are things that you do to run your business every day. What's the best thing you can do to prepare your business for sale? Build a great business. We always tell our clients, you know, the process of selling a company takes 6 to 12 months. And so that's a long time. It's a longer time than I really like. And during that period, we tell our clients, run your business as though you're never going to sell it. And so what's the best way to prepare for selling your business? Run it like you're never going to sell it. Because if you do that, you're going to make the right long-term decisions, and buyers will see some of that and they won't see others. And the things that they do see, let them understand that you've made the kinds of decisions that they won't see the effect of, and be confident that they can pay you a good value. There are some exceptions to that. You know, do you, in the 3 months before closing of the sale of your company, make a big financial long-term commitment? No, probably not. But those are the kinds of exceptions to the rule and not the rule. Now, you know, when people think about or talk about preparing for the sale, sometimes they mean getting their legal or accounting house in order. And entrepreneurial businesses don't always have their legal and accounting house in order. It's always a good idea. It's not critical to do before we show up. One thing you can't be doing before we show up is taking reserves and inventory. That's an accounting thing that you can never get compensated for. But in terms of preparation, private companies often take expenses that don't relate to the business, family on the payroll, other things like that. You don't have to change that before the process starts. We can show buyers what add backs are. It's just that, as I was saying, add backs on inventory don't usually work or stick. So we're getting to a little minutia. We've gone from the very big, run your business though you're never going to sell it, to the very small, add backs on inventory reserves. So I'm not sure where you want me to focus in on that question, but that's our answer. And I think that's a good philosophy. Run it as though you're never going to sell it.
I think those are good parameters. And if anybody in the audience has something specific, just drop it in the chat box and we'll dig into it. In the meantime, one of the most often questions I get from someone wanting to sell their business is, should they take on an investment banker or do it themselves? Can you talk a little bit more about the value of an investment banker and exactly what they do?
Sure. Conceptually, what a firm like ours does is it runs a process that's basically a funnel. At the top of the funnel, you put in the people that make sense as acquirers, and that can be a range of people. And if you run the process right, what comes out at the bottom of the funnel are the people to whom, or the companies to whom the business you're selling has the highest value. And that's kind of the rub. How do you run the process right? Clients often believe before they start the process that the value of an investment banker is their contact list and who they know. That's not real. I don't mean we don't have contacts. Of course we do. But nobody buys a business because they like us or because they know us or because we're handsome and smart, all of which we are. But that's not why people buy companies. So our job is to listen and to understand what is the motivation of a prospective buyer to buy this company. Of course, it's about money, but it's always about something more than money. And when you understand what's motivating them, then you can see who will pay the most and who is it worth the most to. And that's when you can play them off against each other and reach into their pocket and get more value. What we've done in our firm is, first, we've been very disciplined about the business we take on. So we don't take on things that we don't believe will result in a transaction, and we're not seduced by the retainer. And that's allowed me and my partner to work on every transaction. And being able to put our ears into every conversation, or one of us, into every conversation with a buyer allows us to understand who's the most motivated here based on our experience. And I've been amazed at the values we've been able to get for our clients. And you can only do that when you've really been around the block a bunch of times and you understand what you're listening to. So we don't push deals down to junior people. We do it ourselves.
Great. One of the things I see people do when they go out to sell their business is they build a data room. Can you talk about a data room, what it is, how you build it, and how it's used?
Sure. A data room is where you keep diligence information and you permission people to get into it. So it's basically a drive in the cloud. Data rooms are different than traditional drives in the cloud because they track who's been in it and what they've looked at. So you can see who's really doing diligence and what they're doing diligence about. But it's nothing more complicated than that. Back before the internet, a data room was a physical space. That's why they call it a data room, where they'd put files out and you'd go there physically and you'd look at files and decide which ones you want to copy. Most deals have data rooms. Some are more complex than others. They're not critical to how you do a deal. It's just a way of efficiently distributing information on the companies you're selling.
Great. Well, once the data room is set up, what's the process to quote unquote shop your deal to the potential acquirers? How does that work?
Setting up a data room is not a really critical part of the process. It's just a kind of clerical thing you do. But what you're really trying to do is you start by, as the banker, understanding your client and putting together a deck about the business and putting together a list of who you're going to go to. And that's a collaborative process. We write it, but our clients edit it, both the deck and the list. And once they and we believe it's the best that it can be, we go out to the people that we've agreed to go to with our client and we contact them individually, one by one, and we talk to them about what they're interested in acquiring and whether what we are representing fits the bill. We get them to sign a non-disclosure agreement if they want to see our deck. And then we ask them for indications of interest. What's this business worth to you if everything you've seen in the deck is true? We use that as a screening process to say who's worth talking to and who's a lowballer. And then we get the people that we think are the best candidates to meet with our client and allow them access to the data room and to ask other diligence questions and to understand more about the company, get a management presentation, and to make a final bid. Now, I've described it really simplistically, As I was saying, it's a 6 to 12 month process. Getting all that done is a 6 to 12 month process.
Well, great. Well, you talk about screening the buyers based on what they look for and price. What else do you look for in a potential buyer?
Well, what you do when you're doing diligence on your client is understand what are the strengths and what are the weaknesses. Every company is a form of a puzzle piece. It has these protrusions in strengths and indentations in weaknesses. And you ask yourself, who wouldn't care about those weaknesses? Who has the resources to overcome those weaknesses? And who has resources that can utilize and leverage what we have? Very typically in consumer, what you see is entrepreneurial businesses that we sell have creativity, and strategic buyers have a big fat pipeline into the market. And that's often one of the ways in which buyers and sellers match. So you're looking for that, and you're looking for many other things that help you understand who's a potential acquirer of a business that we, for example, represent. And that's how you choose your buyers. Does that answer your question?
Yes, it does. And you mentioned strategic buyers. And so there are strategic buyers and financial buyers. How do you decide between those two? Do you decide that up front, I want one or the other, or do you decide as the offers come in, which way to go?
You don't decide. You let the process help you decide. As a rule, if you decide the type of buyer and the structure of the transaction before the fact, you're probably foregoing opportunity, and you're probably foregoing value. Very often investment bankers come into a meeting and this is a new business getting gambit, and they say X should buy this company, or it's either company 1, 2, or 3 that's going to buy this company. That's nonsense, because it's like putting two young people in a room. You can't predict who's going to have chemistry and who won't. So you have to go to the logical players, and that's how you let the right buyers emerge. And there's usually no substitute for that. So we don't decide who's a buyer before the fact. We be open-minded about it and about structure. Very often, sellers believe that a specific or a small number of strategic buyers are the buyer. Sometimes they are. Very, very often they're not. I never met a seller who found that the process was what they expected.
Great.
So there's a lot for sellers who've never sold a company before to learn. One thing is true: they almost never do a deal without believing that the value they've gotten is the highest value. So you have to run a process that lets them see who the buyer is and who the buyer isn't, and why.
Great. Well, in some acquisitions, the acquirer is actually looking for the team more than anything else. What role does the team play in a retail acquisition? Is that a small, medium, or large part of the discussion at some point?
Well, it depends on the deal, but usually the team is very important. You know, a company is like a painting or a picture. Sometimes there's one thing in it, but usually it's multiple things. People ask me, okay, what's the multiple of revenue or multiple of EBITDA that companies will pay? There's no real answer, because every company is different. You can calculate those multiples after the fact, but no buyer goes into a process saying, I want to buy a company for X times EBITDA or X times revenue. That's not how they think about it. The way they think about it is, well, if you look at consumer, for example, or direct to consumer, they look at gross margin, they look at customer acquisition costs, they look at contribution margin, they look at operating costs, they look at growth, they look at management, they look at the product, they look at how many ways this thing can be improved and where can it go from here. All those things are different for every company. And when you put them all together, you get a picture. Well, how important is the team? Well, the team is usually unique in having been able to create that picture in the first place. So the buyer almost always wants to preserve the team. And, and so they figure out, what are the chances that I can make this business worth a multiple of what it's worth today? What's my risk in getting there? How can I discount that back to today? And that's the value that this business has to me right now. And so you're looking for someone who has cause to believe that they can make this business worth more than anyone else in the next several years, and help them to see a clear path to improving that value. That's the party to whom the business has the most value. And then you have to get them to pay the most that it's worth to them, and not the least that they can acquire it for. That's our job. So it's not really about the deck that we put together. It's not about the contact list we have. It's who's the right buyer? How do we get them to pay the most that it's worth to them? That's really the skill of being an investment banker. And that's not apparent when you start the process. You think it's about, well, you put two people together and they go off into the sunset and make great stuff happen, or not.
Once you have an acquisition price on the table, what can the seller do to actually increase that price? What value or strategies do you think they should be employing to maximize that number to get to the point where they think it's worth that?
The maximum leverage that a seller has is right before they have to give a buyer exclusivity, which they almost always have to do for somewhere between a 30 and 90-day period before the deal. Right before they give that exclusivity, they have the most leverage, and that's when you want to be asking for the best value and the other important terms, whatever they are, in each deal. But the way to maximize that value is to have as many good acquirers in the process and communicate to each of the buyers that they're competing, and make them compete. And you make them compete on all of the points, the major value points that are important to the seller. So of course that's cash at closing, but once you reach a point where you're at or near the maximum on cash at closing, there are other points: employment, who gets retained, who doesn't, benefits, etc. And there are often, in addition to the cash at closing, there are payouts that are contingent over time or take place over time. And those are the kinds of things that you want to negotiate before you sign exclusivity.
Right. What would you put in an ideal buyer profile? What do you look for that says this is a really good buyer, I want to work with them, versus this is a less than ideal buyer? What are those characteristics you look for?
Someone who fits, who has, as I was describing, a puzzle piece that fits, whose strengths overcome the other party's weakness, and someone who has the capital or the financing capacity to, I want to say easily, but nothing's easy, to straightforwardly complete the transaction. Because it does you no good if it's worth the most to them if they don't have the resources to get it done. The other thing is, are they committed to doing it? Sometimes they're doing 5 other things, and it may be a great fit, and it may be worth the most to them, but they don't seem to get around to it, or their answers don't come promptly. That's not a good buyer. You're going to get strung along with a buyer like that. So you have to have somebody who's motivated. They have to perceive the highest value, and you have to have approvals and motivations at the right levels in the company. So, for example, in a large strategic buyer, there are 2 tracks. One is corporate development or senior management, and they have to be motivated and see the value. And the other is operations. The people who operate the related businesses in the company have to be excited about it. And you have to move those 2 tracks along in a parallel way.
Great. Well, if anybody in the audience has a question, please go ahead and post it. My next question is, many of the companies that come to us have the intention of monetizing their data, or are actually doing so. In a retail business, what is the opportunity to monetize data, and how does that impact the actual selling price of the business later?
Well, you have to look at, where does this business make money? So is it from selling stuff, or is it from selling information? For most retailers, it's about selling stuff. And very often, especially right now, information is often not being used as effectively as it could be to maximize the selling of stuff. You know, I write a lot about retail and consumer. And so people ask me, Richard, what do you think is the best opportunity in retail right now? And they're expecting an answer like socks or sweaters or something. And my answer is artificial intelligence, because, and almost everybody who hears that hates that answer. But I believe it's the right answer because there's so much data generated by interactions with consumers that if you can leverage the data in a better way than you can without artificial intelligence, you can make a lot more money and you can be a lot more efficient. So it's about selling stuff and it's about selling it more efficiently. And artificial intelligence is one of the gateways to doing that.
If you had to take two companies that were exactly the same, but one was actually doing what you said, applying artificial intelligence, making good use of data, and the other was not, what would be the differential in the price? Is the other one 50% more valuable, 100% more valuable? What would you put as a multiple difference there?
Well, I wrote an article about something Nordstrom's is doing. Nordstrom uses artificial intelligence to help consumers to choose products that match the style and sensibility and fit of what they've already chosen and put in their basket. Macy's doesn't. So you can't say that artificial intelligence is the difference between the valuation of Nordstrom's and Macy's, but it's part of it. Eventually, everything you do that's smart and good for your business comes out in earnings and performance. So it's hard to isolate the value of data specifically, but if data is being used properly, you're going to make more money. An asset is worth what you can earn from it. So, sometimes people try and say, well, but I have yes, I have earnings, but I also have this other thing. Well, if you can't make money from it, what's that about? So data is great and data is important, but there's got to be a way to make money from it.
Great. Well, we have a question from the audience. Brandon asks, which AI companies do you utilize and recommend?
When you go to a trade show or a conference now in retail and consumer, the exhibit floor is hundreds, sometimes thousands of companies that are exhibiting, and almost all of them tell a very sensible story. I've been a personal investor in several of those. I can talk about that. One is a company in Ireland called Everseen. And among the things they do, it's visual artificial intelligence. So when you go to a checkout at Kroger, for example, and you go to the self-checkout, it watches what goes over the scanner and it sees what's actually been scanned. So if you try and scan a steak and you use the barcode for a paper cup, it sees that and it says, that wasn't the thing that you put in your bag. So there's a problem and it stops the process. And of course, it can also see when something wasn't scanned at all. And it turns out that there are many more, there's a lot more non-scanning than anybody thought there was before they put in these kinds of systems. I'm a private investor in another company called ProQuo AI, also based in the UK. And they do brand management using artificial intelligence. And I think that has enormous potential, not to replace humans, but to supplement their judgment with recommendations from artificial intelligence. There's another company I invested in called Tastetree. They use artificial intelligence to analyze a multi-question, but they'll ask you 5 questions about what flavors you like: strawberries, chocolate, cut grass, and coffee. And then they will chemically analyze thousands of bottles of wine, and they use AI to match the two. And they can recommend what wine you'd like without your ever having opened the bottle. And they can help wineries to blend wines in ways that they know consumers will like. And I think all of these things make purchasing and selling more efficient and therefore more profitable. And on the way, they give consumers more of what consumers are looking for. And that's what retail is all about.
Great. We often hear about a retail company that gets hacked, and now there are personally identifiable information out there in the marketplace. How much do acquirers look at the strength of their IT systems and the cybersecurity and that aspect of it, in addition to margins and the things you mentioned before?
Well, that depends on the acquirer, but you will often find that large acquirers are concerned about the ways in which they are going to be exposed that will make the rest of their business look bad. The last thing they want to do, it's one thing if you buy something and it doesn't work, that happened. We all make mistakes and bad judgments. When you buy something and it doesn't work, and the way in which it doesn't work hurts the entire mothership, that's a really serious problem. It's the worst possible outcome. So data, environmental damage, hurting people, those are the kinds of things that can really damage the mothership, and they do very thorough due diligence about those kinds of issues. I think we are in an intermediate stage on issues like that, because as Web 3.0 develops, one of the characteristics of it is that we're going to have, excuse me, less of these great storage bins of data and personal information. And in the future, Web 3.0 will have personal information being held by each of us about ourselves. And you permission retailers and others to look at that information when it's right. So a giant hack in that kind of setup won't be possible. Your information can be hacked if you're not careful, or somebody's really coming after you, or if a state is coming after you. But those kinds of hacks are happening in a moment in time when those giant pots of information are the only way that information is kept. That's not the future.
Great. Well, a lot of retail companies are moving online and using e-commerce tools in addition to just selling it through the brick and mortar stores as well. For those who have a very well-developed e-commerce system, how does that impact the valuation? How do investors and acquirers look at that aspect of it?
Well, coming back to what I said before, what investors are looking for is, how can I make this grow and make it more valuable in several years from now? Mm-hmm. E-commerce has gone through several metamorphoses. E-commerce for its own sake is just not important. It's about making money. And we've all seen a lot of e-commerce companies basically give away spend $1 to make 99 cents. And that doesn't make any sense. So the question is not e-commerce, but what e-commerce? Does this e-commerce add, and does it make sense? What we're seeing now in retail is that we need a new way to measure the effectiveness of a store. When you look at a store, we used to say, how much stuff is being sold in the store? What's the sales per square feet? But now you have to look at that, and you have to look at what's the intensity of the e-commerce activity in the catchment area of the store. Because we know that people are standing outside the store, live near the store, and even going into the store and standing there and buying on their mobile device or their laptop or desktop. And the store deserves some credit for that, because it's creating the awareness and doing some of the fulfillment for those purchases. And we need new ways to measure stores. So how does e-commerce build the profitability for the entire business? We used to think, or many still do think, of e-commerce as a channel. There are no channels. Consumers don't care about channels. Only retailers care about channels. Consumers care about getting stuff in the most effective way possible for them. Sometimes it's one channel, sometimes it's another, and sometimes it's a combination of both, where you order online, pick up in store, or return in store, and so on. So the channel is not really the thing. It's how do the arms and legs of the business work together to create profitability and opportunity for future growth.
Great. Well, some stores have loyalty programs, very sophisticated ones, point systems, and so forth. How much do acquirers look at that as a real positive versus it's not worth that much? It seems like it'd be worth quite a bit if you can make your customers repeat customers, but how much does a loyalty program drive that? What do you think their perspective is on loyalty programs?
I'm a frequent flyer on United Airlines, and so they treat me better. And that makes it interesting or more desirable for me to keep on flying on United Airlines. I'm not their loyal customer. I'm their prisoner. And if someone else would offer me the same benefits, I'd go somewhere else. That's not loyalty. That's buying friends with money. There's a name for that, but it ain't loyalty. Loyalty with a brand or business is the same as it is with your friends. You have a long-standing relationship. They've done things for you, or you share beliefs that are unusual and unique to you and that you associate with. That is true loyalty, and it's not bought with dollars. What buyers care about is, what is the loyalty? Are consumers, for example, sometimes you'll buy a nice shirt and a friend will say, hey, that's a nice shirt, looks good on you. And you have two ways of reacting. You can say thank you, or you can say, and this is what loyal customers say, thank you. I love this brand. They make great stuff, or it fits me great, or I get such good service, or they believe in the environment, or the product is more sustainable than anything I saw, or many other similar comments. That latter response, that's loyalty. And loyalty is measured when consumers tell their friends in person or on social media or otherwise, because that turbocharges the marketing budget. And when you see a low customer acquisition cost, you know that you have loyal customers because the customers are doing the work, and they're doing the work because they personally identify and want to associate with the brand. And that's why they keep coming back, and that's why they tell their friends. That's loyalty. And it doesn't really have to do with paying your customers to be your friend. So paying your customers to be your friend is part of your marketing budget, and it doesn't reduce your customer acquisition cost. So what is loyalty? I think we use the word in ways that sometimes describe what's truly the opposite of loyalty.
Great. Well, you mentioned branding, and I was going to talk about that earlier. Those with the strong brands seem like they would command a higher valuation, but how do you measure that? Branding can be elusive, and do people actually run Net Promoter Score campaigns, or how do they actually judge that?
People do use Net Promoter Score, but these days people judge whether a brand is a brand with numbers. And the numbers they use are the gross margin and the customer acquisition cost and marketing budget. Let's talk about that. Gross margin, what is it? It's the net revenue minus cost of goods sold. So consumers are smart. They know when they're paying more than the commodity price. You know, if you just need a plain t-shirt, what you're going to pay. And you know, if you pay $35 or $85 for a t-shirt, that you're not paying the commodity price. You're doing it for a reason. And there can be many reasons why you do that. When you have a high gross margin, you know, and consumers know they're paying more and they have a reason for it. That's a brand. When you have a relatively low marketing spend relative to your net revenue, that's a brand, because it means you need relatively little communication to educate your consumer and to bring them back. And because they're coming back because of your brand and their experience and all the things that are involved with that. So the numbers tell you you have a brand, and there's kind of no mistaking about that. So, you know, when people tell you, yes, those are my earnings, but we have brand value aside from that. No, you don't. If you can't, and that's what I was saying before, if you can't earn from an asset, then what's that asset worth? So brand value comes out in earnings. And if it doesn't come out in earnings, then I'm questioning whether there's a brand value.
Mm-hmm. And what are the key numbers do you look for when you're doing an analysis, aside from gross margin, profit margin, customer acquisition costs? What other metrics are on the table to review?
Well, we look at everything, but the other big ones are growth. And of course, you look at the changes in those things. What's changing growth, what's changing gross margin, what's changing your marketing budget. Those are the things that are affecting brands right now. And that comes from the way in which e-tailing and retailing have interacted. Are you balancing those things? And if you are, and if you're bringing good margin to the bottom line after those costs, then you've got great prospects. The other thing you look at is, we sell middle market companies. So our transactions are very often $50 to $150 million, although we do transactions anywhere from 10 to 300 million. And so you're looking at how does the configuration of what the company's doing show me that there's a lot of opportunity in the business. For example, let's say you have a direct-to-consumer brand. If you've opened 3 stores or 5 stores and the stores are performing well, and the heat map of consumer sales around those stores are deep red, then it's probably true that if you have 5 stores, you can probably have 50. And that is just about the clearest path you can have to future growth that you could ever have in retail and consumer. So what they're looking for is that clear path that doesn't require me to do something different. It requires me to do more of what the company is already doing to have the lowest risk possible for future exponential growth. That's what a buyer wants. They don't want business risk, they want execution risk. That's where you get the highest values.
Great. Well, this is my last question, and then we'll see if there's any more from the audience. And the question is, as Amazon came into the marketplace and really grew and took a bigger piece of the retail pie, so to speak, many of the retailers, went online as well, but, it can be tough to compete against someone like Amazon. And so many thought that the way forward for brick and mortar and many retailers was to move into experiences, give people a reason to come into the store and experience things versus just buying them online, because it's very much a commodity. Just go on the website, click yes, I want this, and it shows up. Retailers were differentiating themselves with the store that they had and the people and the experience that you had in buying. Where do you think experiences are going these days, and how much would that impact acquisition?
I think experiences are the future of retail. And it's one of the things that's making the future of retail much more complex, because you need to develop new skills to give consumers the right experiences. And at the same time, it's the right experience for what? If you're selling Hanes t-shirts, there's never going to be an experience. It's just about the t-shirt. You can't. So every company has its strengths and weaknesses, and Amazon has many strengths. One of its strengths is if you know exactly what you want, there's no one more efficient, and you can get a good price. It used to always be the lowest price. Now it's not always the lowest price, but it's a good price on Amazon. And you don't really want to compete against Amazon for that kind of product. But, buying an occasion dress for your daughter's wedding is not the same as buying a Hanes t-shirt. And so that's a place where you can really compete against Amazon because they can't provide the experience. But what you're describing, retail experience, is about more than just how you pick an item. It's about what happens in the store. We're seeing a lot of experimentation with what retail experience is. To me, the paradigm for that is Las Vegas and Orlando. Almost no one goes to those two places to shop. But usually, or very often, when they go there for the experiences they go there for, they wind up shopping. Now, the shopping has to be relative to the experience. Everything needs to relate to each other. You don't see people in Las Vegas walking around wearing hats with mouse ears, and you're not so likely to go to Orlando and buy a Fendi bag. But when the experience relates to the products being sold, and the experience is good and repeatable and interesting and fun for consumers, you put them in a state of mind where they want to shop. And that is very much the future of retail.
That's great. Well, appreciate you sharing that with us today. Are there any other questions from the audience? If so, you can actually unmute and turn on your microphone and tell us more about it, or ask a question if you have before we wrap up for today. We have a few minutes left and we'd love to hear from the audience. Any takers?
First one's always shy.
Give it just a few more moments and then we'll wrap up here today. Looks like we have a good session. Appreciate your sharing that with us today, Richard. Wanted to thank you. We see a lot in the retail market coming in and looking for the next generation of technologies and experiences and what have you. And online is the first step, but I think most groups have done that, made that step forward, but there's many more steps to make as well. And AI and data seems like a great opportunity to go after, because everybody is now monetizing data, not only internally, but also externally, sharing that with other groups. I remember Amazon buying Whole Foods, primarily because of the customer base of Whole Foods location. There were many factors in that case, but the data was also a very key factor as well, in particular those who were shopping at Whole Foods type of people. And so it seems like we're going to see more of that in the future. One last thought is, what else do you think we might see in the future that we haven't touched on today?
I think what retail is looking at now is, I talked earlier about consumers don't care about the channel. The challenge for retailers right now is, how do they get themselves to stop caring? And what I mean is, how do you get the data that you can collect online when a consumer shops online in stores? And how do you give consumers who are shopping online the kind of experience and help and interaction and knowledge and product discovery that you can get in a store? That's what consumers seem to want. And when you make those two channels more like each other, that's a route for success, and it's where retail has to go. But it's extremely complex. It's never been done before. And that is the use of data that I think is going to be the most compelling over the next several years, because it allows each of those respective channels to leverage the strengths of the other and become more of itself.
Well, sounds great. Well, appreciate your taking time to share that with us today. I want to thank our audience for joining us today as well, and hope to see you in the near future and follow up with that as well. So with that, we'll go ahead and close it out. Thanks so much, Richard. Any closing thoughts there?
No, I think I've given about 3 closing thoughts, so I better stop.
Okay, well, very good. Well, we're going to close it out now, guys. Thanks so much for joining us, and thank you for being here. We'll be back next month with another AMA, and looking forward to it. We'll have new information out to you shortly. With that, we'll go ahead and close it. Have a good day, guys.
Thank you so much.
You bet. Bye-bye.